You're watching Notepad. I'm your host, Ibrahim Sani. Maybank Investment Bank very recently cut its 2021 gross domestic product growth forecast, or GDP forecast, for Malaysia to 4.2%. Previously, they have set it at 5.1%. Some of the items that they mentioned included the pandemic-induced lockdown. However, they do expect Bank Negara to keep its overnight policy rate, or OPR, at the current level of 1.75% for the rest of the year. And some of the items that they discuss also include some sectors that they have a little bit more bearish kind of outlook. And the general idea is that 2021 doesn't look too good when it comes to the outlook for the second half of this year. Because of this, I have two very distinguished guests from Maybank IB, or Maybank Investment Bank. Suhaimi Ilias, the Chief Economist at Maybank Investment Bank, as well as Anand Pathmakanthan, the Regional Head of Equity Research at Maybank Investment Bank. Welcome to the show, gentlemen. Let's start with Suhaimi. Let's go through some of the top line ideas following the second half 2021 outlook briefing that Maybank IB did. Maybe some of the key highlights that you want to share with us for this evening.
Yeah, thank you, Ibrahim. I think, as you mentioned, we cut this year's real GDP growth forecast to 4.2% from 5.1% previously, obviously reflecting the impact of the economy that went into tighter restrictions in May and followed by a lockdown since June. But the main point is we are still expecting the economy to recover from the 5.6% decline last year, but it is at a slower pace. And I also want to add that because of this revision, actually what it means is that we do expect a firmer recovery momentum in the second half of 2021. This is especially given the acceleration in the COVID-19 vaccinations that will take the country out of a current phase 1 of the National Recovery Plan into phases 2, 3, and eventually 4, which entails broader economic reopening and the easing as well as lifting of social and movement restrictions. But without a doubt, there are drags to this year's growth as a direct result of the restrictions and lockdowns. In particular, sectors like services, which is 58% of GDP, will be impacted, and we actually lower the sector's growth forecast this year to 4.2% from 5.1%. We slash construction sector growth from 10% to 4.5%, and we also trim private consumption expenditure growth forecast to just 3.9% from 5.9% previously.
And I want to bring you into this conversation because Maybank IB has reduced its end 2021 target for the local FBM KLCI to 1720 from 1830 previously. Some of the items that Maybank IB mentioned included the lingering economic fallout from the COVID-19 pandemic and perhaps rising political risk, or rather the political risk has been there and it's not abated. Some of the sectors that Suhaimi was mentioning, construction and all the others, how do you think this will pan out when it comes to equities, and what would it mean for companies within these kind of sectors that would look at a rather dim second half of the year?
Sure, thank you for the question. So let me set some context for the market first. I mean, when we were at the start of this year, we entered the year quite optimistic. You know, the KLCI had a very good 4Q20, and we felt that rally could continue into 2021. Unfortunately, in January, the market was brought up short by two major issues. One was the reimposition of MCOs, and the second was the proclamation of emergency. So that really was the start of the market stagnation. And if you look at the KLCI over the first 6 months, due to the sporadic MCOs and the disruptions caused by that, as well as the very slow pace of vaccinations, there's been very little confidence in the market. And the KLCI has been the worst performing ASEAN benchmark for the first 6 months of this year. I think contributing to that as well has been the negativity around the politics and where that is heading into the second half of this year in particular. So coming back to where we are now, we think the third quarter will remain difficult for the market. I mean, as Suhaimi mentioned, certain sectors like construction, which we have downgraded to neutral, gloves as well, which we have downgraded as well, are seeing a lot of fallout from the renewed lockdown. Yeah, I think the gloves are very much in the headlines over the last 2 days in particular. And it will take some time for vaccination rates to ramp up to a sufficient level where investors start to feel more comfortable about transparency as to when the economy will reopen. So we don't think that will be a 3Q event. We think 3Q will still be very difficult for the market. We think 4Q, though, should see a lot more transparency or clarity on these overhangs. And then investors can start to refocus on some positives. And there are positives for the market. If you look at corporate earnings, they've been very resilient over the last 3 quarters. If you look at commodity prices, they've been very strong. CPO, crude oil, they've all been trending higher. And if you look at the export sector, tech stocks and petrochemicals, they've also been doing very well. So actually, once we get past these vaccination issues and lockdown issues and the politics, there's actually quite a bit to look forward to in the fourth quarter.
Anand, I just want to stick with you for a while because when you mention things like corporate earnings and the market environment, it's notwithstanding the kind of items that is still pending when it comes to construction, to gloves. The last time you were on the show, you were talking about the ESG compendium that Maybank IB has produced. And again, the ESG element of these kind of companies are still in question. Do you think that the kind of items that these kind of companies within these sectors that you mentioned earlier need to have some sort of structural change and communicate those changes and exhibit those changes to the kind of export markets that they want to do business with, in particular, for instance, to the US or the EU when it comes to the palm oil players? Where do we stand when it comes to these companies upholding all 3 elements of the ESG elements and the structural changes therein?
Yeah, I absolutely agree with you. I mean, for Malaysia, it's been a one-way street on ESG. Uniformly negative headlines over the last couple of years, from plantations to manufacturing to oil and gas. And most recently, we've seen the blow-ups at Cerberdynamic, the NGO accusations against IOI surfacing as well. So it's a continuing negative narrative. The only way out of this vicious negative cycle for these stocks, which are being affected by sustainability and ESG issues, is to change narrative. And that means greater disclosure, greater transparency in terms of what they're doing to address these concerns before they even surface. And I think the government has a key part to play here. It has to flow down from the top. And we have not seen much clarity on key sustainability issues, like is this government going to commit to a net zero emissions target for the country, like so many other countries have? What is our blueprint for EV? What is our blueprint for moving to renewables? All these things, once they are set at the top, can percolate down to the corporate sector. And that's when we will be able to change this negative narrative to a positive one.
Suhaimi, Anand was talking about the market sentiment when it comes to the Malaysian equities. But of course, we want to look at sovereign as well. You mentioned in the briefing a few days ago that Malaysia faces a risk of a downgrade from the credit rating agencies, including that of S&P. You also cited that Fitch, while it has downgraded us by a notch, you mentioned that they have shifted the outlook from negative to stable. What would be some of the kind of notions that you want to share with us when it comes to the credit rating of sovereign for Malaysia for the second half of this year?
Yeah, I think market would be watching closely in terms of what would be the implications to the country's budget deficit. Especially we have additional 4 economic stimulus packages that include direct fiscal injections by the government into the economy following the announcements of or tabling of budget in 2021 last year. No, budget 2021 I think originally targets 5.4% of GDP deficit. But I think with the economic stimulus packages, the additional government spending that comes with the stimulus packages, we actually have revised upwards our budget deficit to GDP ratio forecast to 6.8% from 6% previously. So it's higher and larger than last year's budget deficit of 6.2%, and certainly much bigger than the 5.4% original target by the government. I think what is kind of interesting right now is what we see is actually a mixed rating between the 3 different rating agencies. As you said, Fitch downgraded us earlier this year, and although they actually changed the rating outlook from negative to stable, meaning to say they are not planning or indicating there will be further downgrade in the rating, in the sovereign credit rating. Moody's maintain current rating and stable outlook, while the wild card, I suppose, is S&P, although they maintain our rating, but they also keep the negative outlook. So the question really is going forward, because this year is given already that there will be further, in a way, deterioration in the state of the government fiscal situation. But going forward, what would be the situation like? And I think this is very important in the sense that it's crucial that the economy is back on growth path from at least second half of this year's onwards, so that that will provide some relief in terms of the government from having to continue to inject more and more fiscal stimulus into the economy, and also I think would help the countries in terms of going back into a more stable and a more consolidatory fiscal position going forward. I don't expect very sharp fiscal consolidation or retrenchment next year. I think they still need to maintain some level of support to the economy, because the recovery has, as we know, been kind of slow and somewhat patchy. But I think some sort of indication from the government in terms of what are the medium-term fiscal plans, in terms of tax system reform, in terms of expenditures, I think those are the ones that I think the international rating agencies would be looking at. So at the moment, I think the likes of S&P in particular, although they are maintaining our rating, but keeping a stable, a negative rating outlook, they are actually giving us some benefit of the doubt.
So, I mean, do you feel that the government will communicate some of the short and medium-term fiscal policies ahead of the budget? Do you feel that that will be the kind of appetite that the government is going to approach, or everything is going to be basically dumped during the budget presentation in a few weeks' time?
Well, I'm looking or expecting for this sort of information, if not, fine details in terms of the medium-term fiscal trajectory for the country to be basically shared when budget 2022 are tabled in fourth quarter of this year. So, as you know, these past few years, actually, budget tabling for particular calendar year has also come with a midterm fiscal projections that chart the path of the government finances over not just 1 year forward, but up to 3 year forward. So I think that's basically the situation that we are looking at the moment. So I think they are working on this, and I think we have to wait until the budget 2022 is tabled, which I understand will be sometime in October.
Yeah, Anand, some of the thematic ideas that was shared during the briefing a few days ago was, of course, GLC restructuring. There's one big merger that is happening right now in the telco sector, but of course, the GLC restructuring also embodies that kind of sustainable goals that we talked about, including that of governance. Yes, Cyberdynamic is in the news right now, but Cyberdynamic is less of a GLC play than other companies. Do you feel that now is the time for these kind of GLCs to improve on their planning and execute those planning, because there's no better time than now? What do you think of this?
No, I totally agree. I think there was no better time than a decade ago to start on this journey. But the point is, at this point in time, GLCs are very closely wedded to what's happening politically. We've seen so many management changes among the GLCs, as well as the GLICs like EPF, PNB, over the last few years. It is impossible to expect sustainable reform or changes or restructurings at GLCs when these kind of changes happen every few years. So I think we have to get that issue sorted out first before we can expect widespread restructuring, which is value additive to shareholders. Yeah, so for me, GLC reform is very interesting. In fact, as an analyst, I've written about it for 10 years, but it's never really been able to take off because of these frequent changes. And perhaps because the major shareholders of these companies or the GLCs have been less than active in their shareholdings. We need more activist shareholders to push these companies to change. That might all change, though. I mean, we've seen EPF, being much more vocal about being an activist shareholder in the companies they invest in, and we hope other GLICs will follow their lead. But we haven't seen this yet. Yeah.
To the both of you, whoever that can pick this up, when it comes to the interest rates, OPR is expected to remain constant at 1.75 across the region. There seems to be some appetite for easing. Asian countries have been asked to, or have been looking at controlling their COVID-19 outbreaks. There's some expectations that the Fed might hike. What would be some of the mega trends when it comes to looking at the interest rates of Asian countries, as well as the US Fed possible hike that might take place soon?
Well, Ibrahim, by and large, globally and regionally, central banks' benchmark interest rate has been on what we think or what we see as holding pattern after aggressive cuts last year. Same goes for Malaysia. And even Fed, I think, basically have indicated not so long ago, following the FOMC meeting, that they're not going to rush into raising interest rate despite the inflation situation right now. They're going to be patient. And the indication is they will only start raising interest rate in 2023 at the earliest at this point of time for now. And I think as far as Malaysia is concerned, we are sticking to our view that OPR will stay at this record low level of 1.75% for the rest of this year, and for that matter well into next year, to support the recovery process. And don't forget, interest rate or OPR is not the only policy instruments that Bank Negara has at its disposal in terms of supporting the economy since last year as a result of the pandemic. We have seen the active use of other policy measures, and this is indicated by the comeback or return of a 6-month loan moratorium, as well as Bank Negara topping up its the amounts it allocated for its microcredit and SME financing schemes, and which are these are part of the economic stimulus packages anyway. So I mean, the way we see at this point of time, we are only penciling in OPR adjustment in terms of a 25 basis point hike only late next year, towards the end.
2.0 maybe late next year. That's your expectation.
Just ahead of FOMC's expected interest rate hike cycle.
So the follow-up question to this, perhaps maybe Anand can pick this up, is that because of the possibility of cost of capital being low, raising debt is cheap these days, raising equity is cheap. We got retail investors jumping in on the bandwagon on Bursa last year. This year, there's no difference. A lot of people are trying to access capital quite cheaply these days. Do you feel that some of the companies, some of the corporates in Malaysia might take this opportunity to boost up their infra spend, their capex spend, because of the opportunity for them to raise capital cheaply these days?
No, absolutely. It's a perfect environment actually for M&A. On one hand, you have very cheap financing costs, and on the other hand, you have a lot of asset-rich sectors, like plantations, like properties, which are trading well below their NTA or replacement value. So we've seen this crystallize already of late when KLK bought IGM Plantation stake from IGM. So that is the kicker, starting off. And it's a very sensible deal. It's a win-win deal for both sides. I think there should be more of that happening going forward. And, as Suhaimi mentioned, we don't think interest rates will rise right now. But if you have a 1 to 2 year view, funding costs will not stay this low forever. So if you're a corporate and you have financial muscle, this is the best time to acquire, and you should be going for it at this point in time.
Fantastic. There's also finder's fee and, of course, arrangement fees for investment banks to arrange for the M&A. Wow. I see where you're coming at, Anand. But jokes aside, some of the sectors that you mentioned are facing a tough time, but there would be some upside in terms of other sectors. Would you like to share with us some of the other sectors that are seeing some positives towards the second half of this year?
Yeah, it's really the export-oriented sectors which are very strong right now. I think it's very clear in the trade data, and Suhaimi reports on that very regularly, that our export sector is doing extremely well. The issues with our economy is the domestic sector, and that's because of all the lockdowns and disruptions they're seeing. So sectors like commodities, palm oil actually is doing very well. If you look at oil and gas, we have seen a recovery in oil and gas share prices as well. If you look at export-oriented manufacturing, let's talk about petrochems, PChem, Lotte, share prices have rallied. If you talk about tech has been doing well for a long time, and we think it will continue to do well because it is a super cycle actually for the semiconductor space. And if you talk at more mundane stuff like gloves, yes, the share prices have been retreating because the future average selling prices are coming off. But the fact remains that demand for gloves is still very strong, and that's still very good for our economy and for glove sector earnings.
I think if I can add, I think that's
Yeah.
the beauty of having a diversified economy. So I think while, as I mentioned earlier, and as Anand also rightly pointed out, the domestic side of the economy is still facing a bit of a challenge in terms of recovery due to our in and outs of restrictions and lockdowns. But a global economic recovery helps to cushion the downside to Malaysia's economy this year. I mean, we calculated that global real GDP actually has rebounded in the first quarter of this year by 2.8%. That is after 4 straight quarters of contraction throughout 2020. And we are expecting a robust global economic growth of 6.1% this year after the contraction of 3.3%. That in itself is actually an upward revision from our previous forecast of 5.8%. And the main factor for that is because we actually upgraded the outlook for US economic growth from 5.8% to 6.4% now. So it's actually positive for manufacturing sector because 70% of manufacturing sector outputs are actually export oriented industries. And because of that, we actually upgraded manufacturing sector growth to 6.3% from 5.2%. And another beneficiary within the GDP component on the demand side is exports. We are looking at export to grow 15.5% this year, a big bump up from our previous forecast that was conservative at 6%. And a contributing factor to this also, besides the benefits to the export-oriented manufacturing industry, is higher commodity prices such as oil, gas, and CPO.
All right. Sorry. We're talking about GLCs, large corps, but what would be some of the case for mid-sized corps and SMEs on exporting? Yesterday, I spoke to Matrade on this show, and they were urging or pleading, basically, for SMEs to start exporting their businesses abroad. It's not that often we see SMEs exporting these days. Do you feel that the case for them to export now is, I guess, more compelling than most? Either one of you to take this one?
What we see actually since 2018, as a result of US-China trade war, is relocation FDI. And I think that momentum continues, especially with last year's pandemic when we had supply chain disruptions as a result of lockdowns and so on. There's also another driver for supply chain relocation to ensure resilience and security of supply chain. And I can add another factor, which is events such as the signing of trade agreement, regional trade agreement, like regional comprehensive economic partnership that involve ASEAN 10 countries together with China, South Korea, Japan, Australia, New Zealand. That also create another sort of opportunity in terms of supply chain regionalization. Now, when these FDIs and NSC go around doing this kind of FDI, they also need support in terms of domestic supply chain. And that's where I think there's great opportunities and that can be exploited and should be taken advantage of by our SMEs. And I think it's happening in a way also. And one of the key sort of industry that's benefiting from this is electronics.
Right. Two more questions for you gentlemen. The first is on corporate earnings being good, I suppose. Would we see the government introducing another set of windfall tax or thereabout this year? We kind of missed the boat for gloves last year. Do you think that that's going to be the case for this year? We know that the government is cash strapped. Is this the time to execute that kind of policy? Maybe Anand?
Yeah. No, I think that window has closed. I mean, the best time to have done that was at the budget last year. And there was a small levy, I guess, on the gloves sector. And the narrative back then for gloves was incredibly bullish. So, it would have been well justified for that tax. But this year, things are very, very different. Yes, we have corporate earnings recovery. We had corporate earnings shrinking about 24% last year if you exclude the gloves. And we see it, growing this year by about 28%. So we're really recouping what we lost last year in earnings this year. It's not supernormal in any sense. Yeah. So justifying a supernormal tax on corporates this year, even the glove guys, it's going to be a much tougher sell, I think. And you're going to see a lot of resistance. And obviously, the message it sends to other corporates is, oh my God, nobody's safe. Why don't they tax oil and gas and plantations when, commodity prices are high? And that could be very negative for market sentiment.
Okay, the second item is, of course, political risk. Like I said, it has always been there, but the issue here is it's not debated. The health of the Prime Minister is now under consideration. the continuity of the government is now under consideration. There seems to be a lot of ongoings when it comes to the political players out there, people meeting in some cloak and dagger place situations, and you read this kind of stuff on the net. It doesn't perhaps add to that confidence of consumer sentiment. So maybe Anand or even Suhaimi, do you feel that the political risk situation is going to impact how the second half of this year is going to shape up?
Yeah, I guess boring, safe, cliche answer is, market, investors, businesses does not like uncertainty, including political uncertainty. I mean, we all know political stability has been one of the key fundamental strengths of the country and the economy before this. And the political uncertainty and instability right now has been an overhang for quite some time. I think this is possibly the biggest domestic sort of a wild cards as far as the economy is concerned, because the situation is very fluid. I don't know what's going to happen when Parliament reconvenes, when emergency is over on 1st of August. I'll just stop there because I think for deeper analysis and better
so Anand, Suhaimi gave the
analyst.
But Suhaimi gave he took the easy way out. He gave the cliche, boring answer. Anand, let's hear the more edgier answer on your end.
Okay, if you ask me to choose between what is more damaging to the market, the lockdowns or politics, I would say it's the lockdowns for sure. I mean, we've been in this political limbo. It's nothing new. Yeah, we've been in this phase for the last 2 years.
Yeah.
The market has derated already to, we don't enjoy a political stability premium anymore. You could say that we've sort of caught down with the rest of ASEAN when it comes to political instability. That's already in the price. Yeah, so the market is used to it. Investors are used to it. They just want to know when corporates are going to start growing and earning again. Yeah, politics in the background, yes, probably more relevant to the GLC space. But for the private sector, they just want the clarity on the lockdowns to end. Yeah, they just want a return to normalcy. And whatever happens in politics happens. So unless there's some major policy that comes out from different governments that affects the private sector, I don't see the market being too perturbed. We'll take it in our stride. Yeah, it's really about the lockdowns, not so much politics.
Fantastic. That was Anand Pathmakanthan, the Regional Head of Equity Research at Maybank IB. And earlier on, you just heard from Suhaimi Ilias, the Chief Economist at Maybank Investment Bank, Maybank IB. Until then, thanks very much for watching and goodbye.